Would you wear the same shoes for every occasion? Or rock the same outfit 7 days a week? Of course not. Your style is better with options. Your investments could be too. Cboe Index options give you access to various contract sizes, global trading hours, and potential tax advantages. That's a good look for any portfolio. If you're ready to invest in style, head to betterwithoptions.com. There are risks associated with Cboe Company products. Review the disclosures and disclaimers at cboe.com/US_disclaimers.
Reality radio for a really great future. We're talking real money.
Imagine a world where people actually invested sensibly and logically. Those who sold you investment products acted in your best interest, where no one suggested stupid ideas, dangerous portfolios, or resuscitated bad ideas from the past, where no one needed government regulation to keep them on the straight and narrow. Well, that world is never coming, apparently. Well, not only is it not coming, it's getting worse, Tom.
Yeah, I hate reading
welcome
this
to the
stuff.
podcast.
Yeah, no, I abhor this, but it's really reached a level, I think, where you cannot count on any government entity protecting you.
Well, but step back one step before we get to the government.
Yeah.
Well, what about the investment firms protecting you?
Come on. I know you're joking. I could see the wry smile on your face as you say that. The protecting you?
That is right. I have not had any rye this morning yet.
You probably should by the time we're done with this program.
So I cannot have a rye smile. I might have a slight bourbon smile, but
I can't smell it this far away. No, you know that. You know, well, when we talk about the things that just in the last 10 days.
Why can't we live in a world where everyone loves each other?
Well, they do. They love your money.
Takes care of each other.
They love your okay, because listen to this stuff, okay?
Thank you. I'm with you.
Listen. First, guess what just rolled out? PRIV, the Spider Public and Private Credit ETF, offers retail investors access to...
I thought it was an outhouse.
Well, it kind of smells like one. Offers retail investors access to private credit. Now, they do focus on investment-grade debt for lower risk. Duration, 6.1 years.
Define investment-grade private credit.
Get into that, yeah. Duration, 6.1. 5.49% yield to maturity. Does that sound like lower risk to you? This is a fund that, again, these are things that are launched.
Can you come back with me just a minute? I want to go back to something so we don't get too far away from it. You said what kind of credit? Investment?
Public and private credit.
Yeah. Well, you said something about investment grade?
They call it investment grade debt. That's what they're calling it.
They call it that. How can they call it that?
They can call it anything they like.
When 95% of their portfolio is in double B or worse securities.
And private credit, of course, is financing where non-bank lenders provide loans to businesses. Now, why would those people need to go to non-bank lenders?
Because they can't get banks to lend to them or bonds to float.
Trouble borrowing
Their bonds
through
don't float. Not
traditions.
even in a deprivation tank filled with Epsom salts. Their bonds will not
where
float.
I'd like to be here soon if you don't mind. So, okay, that just came, and the expense ratio is a very nice 0.7.
Which for fixed income is very high.
Yes, it is. So again, there's one. All right, there's one just to get you going. And then I'm glad to read that BlackRock, which I think has just been disgusting when it comes to Bitcoin at all, but BlackRock now has added IBIT, that's their Bitcoin ETF, to their model portfolios. They put it in there. They've added to their target allocation. And so they're going to include, now it's going to be a small number to start with, but they're adding in, this is how it happens. This is how things like, you're going to wake up and go, wait, I have 5% of I thought I was in a balanced, portfolio. Well, balanced by Bitcoin, which has, you talk about an asset that has had the wildest ride in 2020. I mean, look at where it started the year, went straight up, then straight back down. It's been all over the place. But IBIT, that has $48 billion in assets added to the target allocation in the portfolios there at BlackRock. Okay, that one got my attention.
Anything for a BlackRock.
Okay, but this is the worst. Okay, you thought those two were bad.
Those are as bad as it gets.
No, trust me. Because now remember the kind people that almost put us all in the poorhouse in 2008? Remember
you mean the
guys?
Derivative people?
Yeah, the structured finance industry?
Yeah. Got AIG.
All that.
There was a movie.
Yeah,
that was its claim to fame. There was a movie.
Well,
How about there were hundreds of billions of dollars that
that too
were sucked into a black hole.
Wall Street, they just had the big meeting of these folks. 900 meetings set up. Where do you think that meeting would be, by the way? Where would this group meet?
Tropical paradise.
Guess again.
New York City.
The gambling capital of
Las
the world.
Vegas.
Of course.
They need big. Okay, they want a big facility.
At the Aria, of course. My favorite. And it's booming like, guess what? What year are they comparing it to? 2006. Yeah. I mean, you can't make this. This is from the Wall Street Journal. I mean, this is the journal of the business, right? These are talking about the securitization of corporate loans, consumer credit payments on cars, airplanes, golf cars, all this. I mean, really? You read this stuff and you can't even believe it. And they're all together and they're saying, hey, this is really great. It's like old school days again here, like 2007, 2008. Oops. I mean, like 2006. I mean, you literally, you cannot believe this. And of course, no one is slowing any of this down. That's the point of my take when I read all this stuff. You cannot count, and you mentioned, what about the industry? That's a big fat joke, but you cannot count on, it is a big fat joke. They have a new idea every week. They have no due diligence, I don't think, on much of this stuff. And it was for a time when the SEC was sort of slowing it down. The brakes were applied for a few things recently. They drug their feet, and I think wisely so, on cryptocurrency. But you've got to be honest with yourself. You need to expect looser regulation. That means the investor, is going to have to do more due diligence, right? I mean, it's going to be more on the individual than probably ever before, period.
Yeah, which is why there's a basic tenet, not tenant, because we're not talking about rental houses, where there's a basic tenet of investing that if you let this guide you, you are not likely to get taken into one of these bad deals. They're not scams. They're just not likely good for you. And that is, if the pitch sounds too good to be true, it is. Just
and they're
ignore
pitching.
it.
They're pitching big time.
Pitching because I'm looking at some of these structured return funds, the publicly traded ones.
Yeah, right.
Holbrook, Denali, things like this. I mean, they have expense ratios that are right around 2% a year,
which is outrageous.
And wait, but on top of that, they're promising income streams in the 8% range,
which is always great until let me think. What 2000?
Until it isn't.
Yeah, right. It feels really happy. This really, honestly, and I don't frighten. This really does frighten me because people buy this stuff. They get into it. By the way, do you think if we have a problem in the economy, these sort of things will continue to get paid? These,
of course not. They're the first things to go. It happened before.
It did. So the whole idea that happy days are here again, and they're talking about, well, this is post-COVID. Now good times are returning. Everything is going to end up here. I just love reading these quotes. And no, this is not. By the way, this gets back to one of our other basic tenets of the program. You need a strategy, not a series of ideas. These are ideas. PRIV, that's an idea, right? Adding a Bitcoin to a portfolio, that's an idea. That's not a strategy. You've got to have a strategy. Number two around all this is, and we talk about this a lot on the program, Wall Street has a new scheme, many new schemes every single week. the academics that we think you should listen to have had, what'd you say, 4 or 5 in the last 50 years, things that they've really vetted and looked back and said, hey, this worked for a long period of time. Maybe you should have some of your money invested this way, rather than here's a great idea and we can charge you 1.5% to 2% a year for it. And it may or may not work out. Oh, let's just hope it's not 2008 again. Or by the way, the spring of 2020 again. Oh, by the way, 2022 again. Because these are the first things that go bust in those difficult times. That's the point. And this is on you. Sad to say, but this truly is, because I don't think you can expect any protection from the federal government around these things, period, moving forward.
Yeah. And, just going back to your structured note thing, while you were ranting, I was doing some reading. You rant, I read.
That's probably a good combo.
And I'm looking at the portfolio of one of these structured note funds, and oh my gosh, they've got mortgage funds that are mortgage notes that are paying 14%. What kind of mortgage pays 14%?
You know what kind, right? I mean,
holy
that's
moly.
The same people that can't get the loan for their business that can't go to the bank for that.
And the problem with these is that the way they structure these notes, they manage to structure them in such a way that they get a better rating from the ratings agencies. Remember when S&P and Moody's were giving great ratings out to things that were junk? Remember?
Because they
good
were
ratings
getting
can
money.
happen.
Yeah.
Because they were getting money to say better things. And so despite the fact that some of these things will claim they're investment grade, and that means, generally speaking, if they're investment grade, the vast majority of their securities are in triple B at the bottom end of investment grade. But it's not because they're structured notes. You can't trust that rating.
Nope.
It works right up until it doesn't.
And
so here's my advice to everyone listening. Everyone, don't just be skeptical of things. Be outright cynical right now.
You have to. You really do. I mean, and Wall Street's hoping to sell $335 billion in this asset-backed debt this year.
And to whom are they going to sell those?
You know who they're going to. And you know how they do it. What they're going to tell you is, hey, you read everywhere, stocks and bonds are going to make you any money.
Vegas?
Well, that helps. But they're going to tell you that, everybody knows stocks and bonds aren't going to make anything moving forward. You need an alternative. You've got to put something in that portfolio that's going to give you the lift that you need. Do not buy into that. No one knows the future, by the way.
Nice, safe 8% yield. Ha!
Yeah, that's
easy.
Yeah.
Humbug.
Exactly. All right. Let's get to a couple questions.
Let's do some questions.
This comes from Joseph in Lawrence, Massachusetts. Fairly new listener to the show. Quick questions on investing in a taxable account. 42 years old, maxing out my Roth 401k and Roth IRA. Hey, that is awesome, Joseph. Well done. I've started investing extra money. I don't think there's any such thing as extra money in a taxable brokerage account with Vanguard. I don't plan to use this money other than to supplement retirement or perhaps some other major purchases down the road. Now, those are two very different things. Mostly just trying to build a sizable fund for some extra security. All right. Well, those are three different things because one is an emergency account, one is a major purchase, and one is retirement. So I'd think that through a little bit. But says he has $130,000 in the Vanguard S&P 500 Index Fund, VFIAX. When I set up the account, I didn't realize there might be a difference in index fund versus ETF for tax purposes. Can you shed some light on that? ETF versus mutual fund in a taxable account.
Yes. A regular mutual fund, when they sell securities at a profit, they are required to distribute the bulk of that profit to their shareholders as a capital gains distribution. Even if it gets reinvested, doesn't matter. It still shows up as a taxable event.
Yep.
Now, all types of funds, if they distribute income, that income is a taxable event, ETFs or mutual funds. However, due to the way that ETFs are structured, because they don't actually sell the securities when they rebalance a portfolio or liquidate investors, they just move the securities from one pocket to another, there is no taxable capital gains event being incurred most of the time.
Now he
therefore,
does. Therefore, go ahead.
You will very rarely, if at all, see those ongoing capital gains distribution events. Now, those happen a lot
Yep.
In actively managed fund.
But in VFIAX, not a huge problem. He does say he had $2,000 in earnings from dividends in this account. Now,
dividends are different. Yep. Dividends are always going to be taxed.
Correct.
Wait, which symbol was it? Which one?
VFIAX. Because you're adding money to this. I would probably add to the Vanguard, is it VOO, the same fund? But
VOO is the same fund, yeah.
Because you're not going to want to sell the stuff you have in the S&P because it probably has taxable implications there. But moving forward, I probably, Joseph, would use VOO instead of VFIAX. Now, he also asks, is there a way to convert the fund to an exchange-traded fund without fees or taxes?
Yeah.
That, I think there
Vanguard will do that. You can go right to VOO.
Yeah. So
you can go right to
that
VOO.
Would be smart.
And interestingly, though, and that's why I mentioned active funds. Generally speaking, index funds do not realize capital gains.
Yep. They're good at it. Yeah.
The Vanguard 500 Admiral Fund, which is what you have, has not distributed a long-term capital gain in over 3 years.
Wow.
Which is 4 years.
So you can't really get around the dividends.
I'm sorry, 5 years.
Wow,
so
that's a long time. So, but then he asks about what strategies, et cetera. Okay, a couple things to think about here. If you're maxing out that Roth IRA, because here you have, this is all this 130,000. He didn't mention how much he has in the other places, the Roth 401k and Roth IRA. I would want to see you be more diversified. I want to see some smaller companies there. I want to see some value companies there. I want to see some international companies there with small and value in those places too. So that's something to think about in that Roth 401k and Roth IRA. So the strategy should be U.S., international, big and small, growth and value, all of those places. And it's pretty easy to do all of that moving forward, Joseph. But you're doing a great job here at 42, maxing out those things. I think that is really, really excellent work. So well done, sir. Kayla writes us from New Meadows, Idaho. Why do you recommend purchasing bonds within my 401k versus outside in a taxable account? I've been focused on VT Sachs, DFAW, AVGE in my 401k and including bonds in my personal taxable account. Don, why do we suggest in a general, can I say
generally,
that? Generally. I can't say it. They're going to get mad at me. How about,
wait a minute.
Please give me something. Give me a pill or something.
Let me help you out. No,
yeah,
hang on
I hope so. Whatever it is.
Let's see.
I need another word. Thank you.
Yeah,
I appreciate it.
Usually.
Customarily. Okay. Oh, I like that one. That's
regularly, typically,
25-cent
ordinarily.
Word. I like customarily because it's kind of a long.
Traditionally, historically.
This is good. We would suggest holding bonds in
tax deferred.
Yes, because all the interest.
Because of the taxing.
Yeah, there's anything you could do to reduce my taxes would be
because of the taxing. I mean, basically everything you get from a bond fund. Well, not everything, but most things you get from you generally should never expect a bond fund to give you capital gains.
Now, I'm a little concerned that she wrote that she has DFAW and AVGE in her 401k. Those funds would not be available in a 401k because 401ks as yet do not have exchange-traded funds in them. So now I start to think, so that probably isn't an IRA or something.
Whoa, dude. It could be a brokerage.
But she just says 401k. Anyway.
No, but I'm saying it could be a brokerage 401k.
Brokerage. Okay. Yeah, maybe so. But you don't hear them in employer-sponsored plans as yet. So, yes, we would prefer to see the stuff that's going to generate interest in the tax-qualified type accounts like 401ks and IRA. The stuff that's not going to would be in the personal taxable account. How about that?
I'm sorry, but I have to call you on the carpet because...
Okay, please. Glad to see some covering.
401k plans are now using ETFs a lot. How
do they do it?
They put them into
how do you do with the amounts that are going in? That's tricky.
Separate brokerage accounts.
Huh? I have not heard of that. So I'm glad you're helping me with that.
ShareBuilder has an ETF lineup for their 401k.
I wonder how they do it from a pricing standpoint. It's trickier. Because you have to have the dollar amounts are harder to do
sure.
that. But, okay.
Yeah, ETFs they're I shouldn't say in a big way, but they've started coming into them lately.
Okay.
Let me see what the latest number is if I can find it. Like a couple of years ago, I saw 3%.
I think we have them in ours, don't we?
Yeah, we do.
I just remembered they just switched our plan over. So whack me beside the head.
I have
there.
ETFs in my 401k.
I know, me too. So anyway, I stand corrected. So, Kayla, those would be our changes. Yes, we would prefer to see interest-bearing securities in that pre-tax account. I'll put it that way.
Good thing it was 20 minutes into the podcast because a lot of people will have tuned out by now. So.
Exactly. I do want to mention that I'm coming to the Southwest, not just for the sun, but for seeing you on Monday, April 14th. If you'd like to have a meeting with me and Claire Thornton, one of our advisors there, sign up. Go, and they're going to go fast. That's why I'm mentioning it now because we're only doing, I think, 5 or 6 meetings. That's a Monday. We're going to do them at a Regis office somewhere central in Phoenix. Go to talkingrealmoney.com and click on Meet an Advisor and just put a little note in there, meet with Tom in the desert.
In the desert.
Yeah. Where it's going to be sunny and warm. I'll take it.
Yeah. Gunfight at the OK Corral.
I'm not that type, as you know.
All right.
Anyway,
anything else?
I think that'll do it for one day. Really.
Right. Well, one podcast.
Thank you.
Thank you for being a part of it. And thank all of you for being a part of it. And please tell people, the more the merrier in podcast land. So do that and tell them that almost every single day they can go to their favorite podcast service and listen to two old codgers talking real money.
The opinions and views expressed on this podcast were current on the date recorded. Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions. Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy. Information presented on the podcast is not personalized investment advice from Appellate Wealth. The views and strategies described may not be suitable for everyone. This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction. Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appellate Wealth, a fee-only registered investment advisor. Please see Appellate Wealth's ADV Part 2A on our website for information regarding Appellate's fees and services. Appellate Capital, LLC, DBA Appellate Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Appellate does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit TalkingRealMoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. I think I need a nap.